Hi guys, in this clip, Mohnish reveals the untold story of Lilu and he also discusses Lilu's investment strategy and why Charlie Munger loves him so much. As we all know, Lilu is one of the greatest investors and he has achieved a high return for Charlie Munger. In this clip, you will learn 1. Why the crash of 1929 is not really the crash of 1929. 2. Why it is not a bad idea to have cash on hand in today's market. 3. When Monish first met Lilu and how they met. 4. Why Lilu's had unusual childhood. 5. How Lulu switched from being a VC venture capitalist to being a value investor. And 6. What is the similarity between Warren Buffett, Charlie Munger, and Lulu? Enjoy this amazing discussion.
And Warren talked about at the meeting where he said that the crash of 1929 is not really the crash of 1929 because the markets went down a bit, they came back up, and then people thought, okay, we're done, and that's when the real decline came over the next 2 years when it dropped another 85%. So to me, I think that there's a big disconnect between what is happening in the real world and what is happening in the equity markets. And I think the only conclusion I can draw from there is it's not a bad idea to build cash. Even if one ends up, even if none of these gloom and doom scenarios kind of play out, one can start putting it to work a year and a half from now.
Don't forget to like and subscribe if you haven't done it already.
Lilu and I have been friends for many years. I think I first met Lilu. I think it was 11 years ago, and Charlie introduced the two of us, and he actually he forced us. He said, "I don't really care whether you really like each other or not, but I want you guys to meet at least once a month for lunch." And so what we used to do is we did that. We basically used to get together and meet, and I got to know him quite well over the years. I think Lilu has had this would become a long topic to go through, but on this call. But I think he's had a very unusual childhood, a very difficult childhood. He was one of the most wanted men in China because he was one of the leaders of Tiananmen Square, and the Chinese government basically wanted to put him away for good. And some people in Hong Kong helped smuggle him out of China, and then they got him to Columbia. And he actually did three degrees at Columbia simultaneously. He did an undergraduate degree, and he did an MBA, and he did a law degree, and he finished all three degrees in 4 years. And that's kind of unprecedented at Columbia. No one's ever done that before or since. The thing is, he was on student loans at Columbia, and so they used to give him the money kind of ahead of, maybe 3-4 months ahead of when he had to pay his rent and other things. And he used the, in effect, student loan float and invested that. And by the time he finished at Columbia, he had made $1 million on the float. So he was a millionaire.
Wow.
So he was a millionaire. Basically, he was like, they would give him $20,000-$30,000 for the semester, and then he'd start investing that, and it would be $70,000-$80,000 by the time he actually had to give the money and so on. And so he did really well as an investor. He used to be mainly a venture capital investor doing early stage businesses and such, and then he later switched But I would say, Lilu is very much kind of a Swiss Army knife kind of investor. He likes to get to know the companies well. He tends to hold them for a very long time. He has a very rich understanding of these businesses, and I've had some amazing conversations with him. Uh, I don't know how much of it he wants me to put in the public domain, but I would say that he's got very unusual hiring. And both Buffett and Munger, one of the big things they bring to the investing game is they're really good at focusing on the downside. They immediately hone in on what can go wrong rather than what can go right, and they're able to put a lot of things away very quickly. And Lilu is quite similar. He's very focused on what can go wrong, but he's also very good at identifying long runways. Getting to know the entrepreneurs and the business leaders, and then he has some companies in his portfolio that have been with him. He's had them for 15, 20 years in the portfolio. So unusual wiring, wonderful guy. And Warren talked about it at the meeting where he said that the crash of 1929 is not really the crash of 1929, because the markets went down a bit, they came back up, and then people thought, okay, we're done. And that's when the real decline came over the next 2 years, when it dropped another 85%. So to me, I think that there's a big disconnect between what is happening in the real world and what is happening in the equity markets. And I think the only conclusion I can draw from there is it's not a bad idea to build cash. Even if none of these gloom and doom scenarios kind of play out, one can start putting it to work a year and a half from now. Most businesses are extremely fragile creations. They have learned to survive with very brutal competitive forces acting on them, and they are barely able to survive. They make a few percentage points of profit in normal times. Bill Gates used to say, when he first started Microsoft, that he wanted the company to have enough cash so it could go for 2 years without getting paid. That he could pay his staff for 2 years if Microsoft never got any revenue. Most businesses cannot pay their staff for even 30 or 45 days if there's no revenue. So most businesses cannot survive for even a few weeks. And so what we are seeing going on in the real economy with small businesses across the board is a lot. It's huge, and not accounting for. So I think caution is a good way to approach this.
Thank you guys for watching. I hope you enjoyed. Don't forget to hit the like button and to subscribe if you haven't done it already.